Okay, let's start our class for today. I hope you can see my screen. So today we're going to look at financial analysis and decision making. So basically here we look at how to analyze different financial information that is provided to us and how it can guide us or help us in making decisions as CFOs of the company, as board of directors of the company, as leaders or decision makers. Okay, so under decision making we'll look at investment decisions. We have under investment decisions, we're going to look at the importance, investment appraisal methods that we can use, how we can be able to compute the accounting rate of return for the different projects and their payback periods, their net present values, and the IRR. Then we shall also look at risk and uncertainty. Here we shall look at the nature and managing of risks. Then tax and financial reporting implications, how relevant they are, what is the impact if we do it and if we omit it, what mode of financing can we use, and the tax implications that are involved. So that is about the decision making, and then we shall also look at the second part of finance evaluation, where we shall assess the the financial performance, the non-financial performance indicators, and the balance scorecards that you can use when you are trying to assess the different projects. Okay. So like I said, under this topic we shall look at analyzing different financial information that has been given to us and how we can use it to make different decision making. What techniques we shall use when we are trying to make these decisions. So it's very important in SBL, it's very important to be able to analyze different financial information and how you can arrive at different figures. But computing it will not be something that will be necessarily required from you in this paper. So things like IRR, things like NPV, ARR, payback periods, they will be quite important for you to know which project to take on, or how to advise management on where they can be able to invest. So you need to know how to be able to compute, but we don't need to do calculations in this paper. Like I said, SBL is a theory paper. We do mainly analysis, we don't do computations. Those will be done on a different paper like AFM or FM. SBR is where we will need some computations of that sort. But in here, we have minimal computations that will appear in the exam. So let's look at the importances of financial analysis. So in layman's language, or in our day-to-day activities, what would you think would be the benefit that you would get when you're trying to make investment decisions? What is the importance of you making analysis to come up with which investments you can be able to invest in? It makes it easier for you, one, to assess the risks. It makes it easier for you to know how much money you will need. It makes it easy for you to know how much time the project will take, what people you will need to have on board, what products you will need to maybe use in terms of, let's say, input for you to get an output. You look at that it helps you to be able to see all the different angles that you need to consider before you're already in the process. So it's like it helps you in the preparing yourself as an organization so that you do not get into something and then you're like, we did not know, or we were not informed, or were not aware. You get into a project, let's say you're excited about the profit, but then you don't know that this project is going to take much time, as maybe 2 decades, and then 3 years down the road, the investors or the shareholders are saying, why are we not getting our returns back? Imagine you're investing in stock exchange, some not stock exchange, foreign exchange, whereby the risks are high, yes, the returns are very high, and you're happy about the returns, but maybe you've not considered something like how much time it will take for you, for the curve to go up. For if you've, let's say, invested, or you've bought let's say a USD currency at 3,500, it means you cannot be able to sell until maybe it has gone above 3,500. It should be 3,600, 3,550, something above. And then immediately after you've bought, the curve goes down, and then you have to wait, let's say, for maybe 3 years for it to be stable and get back to the normal price, or even better. And then before you know it, everyone whose money you've used to invest is complaining. The shareholders are frustrated. The risks are almost above their risk appetite, and then now you begin to give excuses. So that's why it's important for you to be able to have information, check it around, communicate, do research before you do investment. So that's what what is here is what we've talked about. Large amounts of resources, it helps you to know large amounts of resources that are often involved in the investment. It helps you to identify difficult and expensive to abandon an investment once it has been undertaken. So I have different methods that we can use to do appraisals for different projects, like we talked about. We have NPV, we have payback periods, we have accounting rate of return, and then internal rate of return. I don't know if any of you has an idea of how to compute this before we go further. Anyone? Please let me know so that I can know if to skip that part, or if we really need to go through it. Each one of you, please give a feedback. Nagai, Jane, Cecilia, please let me know. Do you know how to do these computations? Have you seen them in FM or AFM?
Yes, I have.
Okay. And Jane as well? Okay. So let's begin with accounting rate of return, or something that we call ARR. So in this, let me see if there is a formula. Okay. So the accounting rate of return, we use a formula whereby we get the average profit, we divide by the average investment times 100. It's in percentage. So where your profits are, where your percentage is bigger, the better, because it means that your profit covers as much more as the investment. So the bigger the ratio, the better for you to be able to take on that investment opportunity, depending on what the other options are. So here basically we look at how much return or how much profit we are getting vis-a-vis the amount of investment that we incurred at the point of inception. So it's often used internally when selecting different projects that are options to an organization. However, it does not consider different things. It doesn't look at things like cash flow. It doesn't look at doesn't take into account that the value for money. If you're saying we're going to invest for 2 years, what is the inflation that is going to happen? We don't know, because it doesn't incorporate into the inflation. It also doesn't look at the risks. So in a way, it may not be it may not be the best method that you can rely on exclusively to make a decision if you can invest in a project or not. Then we have
You're breaking. We can't hear you.
And how about now? Where is the Wi-Fi? Can you hear me now? Hello? Someone
Yes,
please
yes,
let
we
me know.
can hear.
Okay, thank you. So let's proceed and look at the payback. So under payback period, we are looking at if we make an investment today, how much time shall we take for us to be able to recover the amount of money that we have invested today? That's what payback period looks at. So here it helps you to know, or it helps you to prepare yourselves as an organization to plan ahead. If we are expecting to invest in this project and then we shall get our money in 5 years from today, what things do we need to have in place or for us to be prepared? Is it the cash flow? Is it the or should we expect that maybe there will be no returns in maybe the first 5 years before we get to a breaking even point or the payback period? So it helps management or even the investors to be aware to know how much time it will take for them. So payback period is good in a way that it helps you know the investment costs that you're going to incur and how much time it will take for you to be able to get them or to recover them. And of course, the projects which have shorter payback period are more preferred compared to the periods that have longer payback period, because the longer the time, the more the risks. However, when you're using this kind of method, it has things it doesn't consider. For example, the cash flow that occurs after the payback. It only considers the amount of money that is involved from the point of investment up to the time when you recover your money back. So it doesn't look at the cash flows that will come at the end of after the payback period. So it ignores them. Then you also have to know it doesn't consider time value of money, since it doesn't use the inflation rate, and it doesn't give you indicators or indications on the potential impact on the project on the total value of equity. So those are some of the disadvantages that we get from using payback period, as if you decide to make an investment based on only that computation. Then we have NPV, which is usually regarded as the best, the most preferred way of computing whether or deciding whether we can take on the investment or not. Why do we say it is better? Because it looks into the cash flows for all the periods, even after you've broken even. Looks at it considers inflation, so you can be able to see the time value of money. It is complete, so it's absolute, that's how we could say. And then it gives a link between the change in shareholder wealth. So it's much diverse, or it's a bit complete compared to the first two that we looked at, because now this one looks at that it considers the different, that it incorporates the different things like the discount rate, the cash flows for all the periods, initial investments. All that is taken into consideration. However, when we are doing NPV, we usually have we use a discount rate. This discount rate, we forecast that this rate may not change, which could be false. Maybe after some number of years the rate could change, and a small change in the rate could affect the project as to how you had computed it. So imagine if you made a computation today and you're using a rate of, let's say, 10%. 2 years into the project, the rate changes, and then maybe it is 13%. And with NPVs, the higher the rate, the lower the profitability. So if the rate increases, the discount rate increases, it means that now it would affect the profitability at the end of the project. So it's very sensitive to the discount rates, which makes it a little difficult to assess what would be the actual actual return at the end of the period of the project life. Then it also looks at uncertain forecasts of the future cash flows, because it is an estimation, it's not an actual consideration. Then we have IRR, or what we call the internal rate of return. So with the IRR, you know that after we've done the computation of the NPV, then we can get an assumption of a different rate. We get also the NPV at that rate, and then from that we get an average. That's how we get to IRR. IRR is a point whereby we are at a neutral, zero. The NPV is at zero. So if let's say you did the NPV at 5% and the profit is, let's say you have a positive NPV, now it means you can increase the rate to, let's say, 10%, get a negative NPV, and then do the computation and get to a point. You keep estimating different rates up to a point where you will have the NPV at nil or at zero. So that's how IRR comes about. So the advantages of using IRR: it uses cash flows as much as NPV does. It also looks into time value of money because it uses the discount rates, and these we compute the money for the future on today's rate, on today's if you're making an investment in 10 years time, we bring the money to today. So that's how it incorporates into the time value of money. And then it can also be able to annualize return over a project's life. However, there are some challenges that we also get from IRR, like any other method of making decisions of investment. One of them is that it assumes future cash inflows, which may not be actual. Then it also doesn't give the potential impact on the value of equity as much as NPV. And then it's not suitable when you're choosing between the mutually exclusive projects, as projects with a higher IRR will not necessarily have a higher NPV. So those are the different challenges that we may tinker when we are using IRR. So there are different examples for computation that I've put in the handout. You can check through them and then you can see if you recall how to do those calculations. So it's very important for us to understand or have an idea of how these things are done. Good enough, there are also formulas that have been included. Any inquiries before we can proceed? None? Okay, so then if there are no questions, let's proceed. Let's look at project abandonment. What is abandoning in simple terms? So abandoning is more like, in simple terms, is more like setting aside. So when we use project abandonment here, we make assumptions when we are trying to make the decisions on which projects to go ahead with or which ones to defer compared to the others. So these abandonments could be in favor of the decisions and result in more favorable outcomes, or they may work against the decisions as a result of less favorable outcomes. So if the outcome projected using the updated assumption is no longer meets the acceptance criteria, then the project can be set aside or it can be abandoned and it will not be considered. So there are different costs that we incur, and these costs need to be analyzed as we're trying to do the abandoning of the different projects that are available to the organization. Why? Because there will be additional costs that you will need to consider. For example, if you say we're going to take on this project and then midway you say no, this project doesn't seem to give us enough returns, let us abandon it for the meantime and continue, you will need to put those workers who are on that project on hold. So it means you need to pay them redundancy costs or even termination costs, because at the end of the day you cannot give someone a termination without a compensation. So you need to consider those costs, if they are too much or if they are high, and then you need to think otherwise. So that will affect, of course, if you decide to do abandonment, it will affect your financial, the financials of the organization, and as well it will affect the reputation of the company, as it will have a stringent relationship now between the people who are working there, the employees, the suppliers who have been giving you commodities, maybe the customers who are benefiting from it, or even maybe the government. So all that needs to be put into consideration. Okay, are we together?
Yes.
Okay. So now let's continue. So let's look at managing risk. The different ways we can be, methods that we can put in place to be able to deal with the different risks and uncertainties that are faced with an organization, or at a point or when we are doing the planning for selecting of different projects, for planning for the company. So we need to do that at different stages when we are selecting projects, when we are calculating the NPV, especially when we are using a risk adjusted cost of capital. Or also we will use we need to assess the risks if we're going to check the sensitivity analysis on the different projects basing on their success factors. We can also use it when we are doing when we are having calculations for expected values, especially when we're doing multiplication of the outcomes based on probabilities of their likelihood to occur or to happen, and then in simulation models. So how relevant are they to us, or how relevant is it for doing risk management and planning to an organization? Of course, if you are a listed company, it's very important for you to assess the risks, because at the end of the day you're working on behalf of the shareholders, and these shareholders have something that have a vision, or they have a goal that they are looking at the end of the financial year. Not forgetting that we who are working in the organization, we are not the actual owners, we're just working for the shareholders who have contributed or brought together their funds for the financing and running of the organization. So it's very important, or it's relevant enough, and it impacts on the project, also the financing, and the key ratios that we use when we are doing financial analysis for the institutional investors, and also for them to determine whether they're going to buy or sell or hold their shares. So the different ratios that we can use, for example, the earnings per ratio, or something that we call the EPS, then the ROE, which is the return on equity, and then the ROCE, which is return on capital employed. Then we also look at it's important when we are looking at financial gearing or looking at how much the company is into debt plus the interest cover for the organization. So what impact is it on the organization? So different expenditures that we make when we are starting to do the investment. When we are doing calculations, for example, in year 0, we bring the cost. Remember, let's say we have a 5-year project. We have year 1, year 2, year 3, year 4, and maybe year 5. So in year 0, we bring the cost that we incurred. Sorry. So I was saying, in the year 0, we record the cost that we've incurred on the project, or let's say an asset that we've invested in. So it will be at its cost, but this amount will keep changing over time, or as the project years now or as we are considering now in the different project years. Let's say in year 1, year 2, year 3, up to the last year, which was our year 5, for example. So the things that will affect it, for example, the depreciation or the amortization policies that are in place. Then revaluation policies, especially now, if we say we're going to be revaluing at the end of in each financial year, what is in place that you need to put into consideration when we are doing the revaluation process. And then we look at things like impairment as well. You could have bought the asset in year 0 when it was, let's say, 5 million, and then something happens. We could give an example. I don't know if all of us understand what impairment is. So in year 0, we bought a car. I don't know if the car is the best example I can use, but let me see. Maybe we bought land. We know land doesn't depreciate. So we record in year 1, our land was 5 million. 2 years down the road, the weather is not very good and the water is too much. There is a landslide. So the land is no longer at the value that it was at the point when we bought it. So the land has impaired. So you look at things like that, how they will impact the project or the particular asset that we have purchased for investment. So those are the things that you will consider or put in place. We can now look at the modes of financing an organization, the different financing modes that we can use as an organization. We had also looked at some of these, I think, in the previous class. So we can say we can do financing by internal equity finance here, where we looked at things like using retained earnings. We looked at preference consulting your preference shareholders, your ordinary shareholders, where you can maybe give them other shares so they can give you extra payment. You can use their dividends, you use them for investment. All those are internal equity finance methods that an organization can use. Then we also have the debt finance. Under the debt finance is where now we can have more liability coming on. So we can either take on loans, we can borrow money from different people that can be able to avail us with the amount that we are looking at. The only challenge that comes with debt is that it will affect the financial gearing of an organization, because the higher the debt, the higher the gearing. Well, the curve will first be, it will be moving upwards up to a certain point whereby it will hit the maximum and then it will begin to fall. So as the company is gearing, first at the start, as the curve is climbing, it's good for an organization. But then when we get to an optimal amount of debt, then of course our curve will begin to fall down, and it will have an impact on different things, especially on the investors of the organization. Then we have external equity finance, whereby we can do rights issue of shares. We can do additional, we can publish additional shares to the market for shareholders to buy and provide finance to an organization. So the different tax implications that come along with the decision that you decide to choose as an organization for financing yourself or the different projects that you want to take on. So I don't know if you remember from our finance management, there are good things that you will get from. Hello, can you hear me? Are we still together? Anyone can hear me?
Hello.
Okay. Yes, Cecilia.
We've lost you.
You can't hear me? Or can you hear me now? Okay. So I was saying there are tax implications that you will get depending on the method of investment or financing that you'll choose as an organization. You know, when we take on some debt, there are some benefits that we get. For example, when you have a loan amount you've taken on, you know that the interest or that amount is not subject to taxation. That's when we will have the net present. Let's say, for example, in the statements we'll have something like the net profit before interest and tax, and then we'll less the interest, and then we can be able to compute the taxation. So it saves you, or it gives you a tax allowable on the debt that you've taken on for project financing in terms of interest charged by the finance provider. Then tax saved on tax allowable depreciation granted on the project's non-current assets are also a benefit to the organization, plus tax paid on the project's return. This will be straightforward. But remember, there will be additional issues that will rise in making foreign investments. For example, if you're making a foreign subsidiary, so it means that now when you're having a subsidiary, you'll have implications like, for example, bilateral tax treaties, whereby now if two countries, for example, have signed a bilateral tax treaty, it means if you've been taxed in country A, when the profits or when the asset or the money is transferred to country B, it does not go under taxation again, so you can be able to avoid double taxations. Then it also helps on import duties. Import duties could be a disadvantage, or they could be additional costs if you have to pay import duties when you're transferring goods from one subsidiary to another subsidiary. But for countries where the import duties are maybe waived off for particular products that you're dealing in, it means that it could be an advantage to you. So it depends. Also look at the withholding taxes, especially on the dividends paid to overseas parents. There will be some taxes that you will deduct from them before you make a payment to overseas investors. So that could be a challenge for a subsidiary company whereby the parents will be taxed from the company of payment, and maybe they could also be retaxed from the company of receiving in the country of receiving the payment. Yes, Jen, are you saying something? Hello, Jen, could you please mute your mic? Okay, thank you. So those are the implications that you could put into consideration as you're checking on which mode of financing and what gearing level is the company intending or willing to take on or get itself involved into. I don't know if there are any questions. Okay, if there are no questions, then you can be able to proceed. So let's look at performance measurements. These help to show how successful an organization has achieved its objectives. The main objectives here that we look at are the objectives which have been set, if they're either quantifiable or they are not quantifiable. Maybe if they are subjective form of appraisal. We also look at the judgments that we have put in place, if they are fair, especially the outcomes and the controls that are involved in the project. It also looks at objectives that look at the design measures, if they are consistent within a strategy for each level of the organization. So the different things that we can use to be able to calculate the performance of the different projects. For example, we can use something called ROI. We had looked at it before, or what we call the return on capital employed. So here we look at the profit of the organization at the end of the year. We divide by the equity and multiply by 100 to be able to identify what percentage we have achieved as an organization. So the higher the percentage, the better for the project performance. So if you're doing an analysis and you see a project which has a higher percentage in terms of return on capital on equity, then you should take on that project. You should take the project which has the highest percentage. Then we have return on capital employed, where we look at the operating profit and then we divide by the share capital plus reserves and long-term liabilities. We multiply by 100 because it is also in percentage. Also, the higher the percentage, the better. Why are we saying the higher the profit, the better? The higher the percentage, the better, because it means that the profit you've gotten can be able to pay back on the equity, on the amount of funding that we've put in. So that guides you on being able to know if either we should take the project with a higher percentage or the project with a lower percentage. So for the ROI and the ROC, we take the projects which have the higher percentage. Sorry, just a second. Okay. Right here. Then now let's look at profit margins. Now we are trying to see how much profit are we getting based on the different projects that we decided to invest in as an organization. So we can use a formula, for example, one of gross profit margin, where we get the gross profit, we divide by the revenues, and then we multiply by 100. So at this point, do you think we would take a project which has a higher percentage or a lower percentage? Someone tell us. Someone please. No one. So anyway, we'd look at a project which has a bigger percentage in terms of the gross profit margin. Because now look at it in this way: if you have a project and then the profit margin is decreasing, what are the things that would come into your mind as first instinct? Maybe either the selling price of the goods is maybe reducing, or maybe the costs that you're incurring to do the production of those different goods is increasing. That's the only way the profit will be affected, and it will be reducing. So if the profit is reducing, it means it's not a good sign for the organization, especially if it continues for a longer time. So it means it would not be, at the end of the day, if the gross profits are low, if the gross profits are lower, it means also the net profits will become much less. Because now imagine gross profit is before you incur other costs like maybe salaries, rent, and what all the fixed costs, admin costs, and operation costs. So before you incur them, the profits are already coming low. So it would be something that would signify, or it would be showing a red light to an organization at the point when they are doing planning for investment in different projects. Then we have net profit margin. We can also use this, and here we use the profit for the year. We divide by the revenue times 100. Note that there is a difference between the gross profit margin and the net profit margin. Under the gross profit margin, we use the gross profit. Under the net profit margin, we use the actual profit or the net profit for the financial year. So don't confuse the two. So when you use profit margin, what are some of the things that you would put into consideration based on the results that you're getting? The net profit reflects different things. For example, the number of costs. If your gross profit margin was higher but your net profit margin is lower, it means maybe the costs are too high. Maybe admin costs, maybe financing costs, different costs that would affect the net profit. You'd also need to look at the cost of debt financing. If you're using debt financing, what is the interest that you're getting, or the finance costs that you're incurring as an organization? Because at the end of the day, it will affect the net profit of the company. We also have to look at the underlying population or popularity of the company's products and services. How are they being consumed? If the profit, for example, if the consumptions are low, it means that from the word go, the gross profit will be low, and this will also reflect into the net profit being lower, because the products are not consumed in big numbers and less profits are being recognized by the company. Are we together as of that? Can we continue?
Yes.
Okay, so let's continue with asset turnover ratio. With asset turnover ratio, we look at revenue that we've collected, we divide by the capital that we have used to invest, or the capital, or we'll call it the capital employed into the project. So here we try to see what are the sales revenue that we've collected vis-a-vis how much have we invested in this project to get it to its current position. So how can we get this turnover ratio better? So the different things that you can look at, maybe it can be low if maybe, for example, you have a lot of assets that you've bought and you're not putting them to use. So maybe you can sell off some of those non-current assets that you're not utilizing at the moment. Also, you check the impairments and the writing down of the values of different assets. If you've not been doing so, it means that the amount of capital employed is going to keep high, yet it should be lower because of the different impairments that have incurred, or the depreciations that have occurred on the assets that we had purchased in the running of the project. We can also get the ratio better by improving working capital management. For example, ensure that you collect the receivables, try to get them as much fast as you can, or reduce the amount of money that you're putting in inventory, like having too much inventory that is not necessary for that particular moment. So that's the way you can be able to improve the asset turnover ratio. We have also the ROCE, which we had looked at before, which is the operating profit margin multiplied by the asset turnover. So if someone says calculate the ROCE and you don't have the asset turnover, neither you don't have the operating profit margin, you'd have to first compute that to be able to get the ROCE. We also have ratios that we can use, especially the liquidity ratios. So we have the current ratio and the quick ratio. Under the current ratio, we have the current assets divided by the current liabilities, and these ones should be at the end of the year, not at the start of the year. Vis-a-vis quick ratio, whereby we get the current assets, we less any inventory that we have, and then we can divide by the liabilities, current liabilities at the end of the financial year. So this will show you if the company is liquid, if they have financing, or if they do not have, because we look at the current assets and the current liabilities. We also have something called gearing. Under like I said, gearing is getting into debt. So under gearing, we look at the company's finance that has been provided through the debt channel or by debt. So we can compute that by using the gearing ratio. We're trying to see how much the company has consumed as debt, and the higher the rate, the higher the gearing ratio, it shows the higher geared the company is. So when you're trying to choose a project to invest in, for example, you'd want to know if this project is highly geared, what are the implications that you would get vis-a-vis the positive implications? What would be the negative implications that you can get, or that you would expect at the end of the period? Maybe you would expect there could be a risk of the company being not performing well, so they have to rely on a lot of debt. There could be a risk of maybe bankruptcy in case they're not able to pay their debt. There could be a risk of losing assets in case they do not pay their debt. But there are also other benefits like tax waivers on the tax benefits on the interest that you would incur. And any other benefits that there is, like we looked at before in the first part of this chapter. Just a minute, let me get some water. Okay, so let us now continue. Let's look at interest cover. What is interest cover? In simple terms, even before looking at the calculation. Anyone has an idea? Anyone who can explain interest cover in layman's language? Anyway, when we say interest cover, we're trying to look at how many times can a profit that we have been able to generate as at the end of the year, we can pay the interest. Is it one time? Is it two times? Can a profit cover the interest? Maybe 10 times. That's what interest cover looks at. So we compute it by getting the profit, operating profit for the year, and we divide by the interest amount, so we can be able to know how many times our profit can cover the interest that we have to pay as an organization. So this helps in you knowing if you can be able to take on maybe extra debt, like you can afford to have extra interest cost or not. Then we have investors ratios. Here we have the EPS, or the earnings per share, where we look at the profit for the year, we less the preference dividends, and we divide it by the weighted average number of ordinary shares that we have issued to the public. So want to know if we have had shareholders, how much the earnings they can be able to get, how much earnings they can be able to get per share of their investment. Then we have dividend coverage, how much dividends they can be able to get, and this especially will be for the ordinary shareholders. So we get the profit for the year, we less the preference dividends, and we divide it by the ordinary dividends to be able to know the dividend cover. Then we have dividend payout ratio, where we use the ordinary dividend, and we divide it by the profit for the year minus the preference dividends. So these are different, and you should not confuse them. I don't know if you are together, because none of you is communicating or letting me know if they have any inquiries. But ensure that you don't confuse these. The dividend cover is different from the dividend payout ratio and the dividend yield. We also have the price earnings ratio, where we use the ordinary shares, we divide them by the earnings per share for the ordinary shareholders mainly. Remember, the earnings per share, we said we use the ordinary shares, the weighted average number of ordinary shares that we have issued out. Are we together? Okay, so I think let's now proceed. So there are all the different performance measures we've looked at. Majority of them rely on financial measures, but different companies have different weaknesses other than the financial measures, or only other than considering the financial performance indicators that affect the company's performance. So the financial performance indicators mainly will focus on maybe cost reduction in the short term. They may ignore other drivers that would affect the business success, maybe the delivery, maybe the after sales services that you offer to the customers, customer satisfaction from the goods they've taken, or even the quality of the goods that you're producing for the clients. So finance performance measures usually do not put into consideration, or they tend to ignore those other factors that would affect the company's performance. So what can we be able to do to solve that particular problem? So we can also be able to use non-financial performance measures that encourage managers to take account of other factors that will drive the success of the company other than the ones that have been looked at before in the finance performance indicators. So the non-financial performance measures now will aim to measure how well the organization can be able to achieve its objectives by identifying what is important to the organization, and how it can be able to identify the different objectives that need to be achieved. Just a second. Okay, so let's proceed. So what are the objectives, or what are the objectives that we are now going to consider when we are using the non-financial performance indicators? First of all, with an objective, you're trying to look at something that is specific or measurable that can be done or achieved by the organization. And the performance measures, here we look at both the qualitative and the quantitative characterization of performance used to evaluate the progress of the projects in the and the achievement of the projects, of the objectives, that have been set in the organization. So the objectives that we can be able to, as we're setting objectives, we can be able to follow something that we call a synonym that we can call SMART. So under SMART, we have objectives should be, the S will stands for the specific. Objectives should be specific, because if they're not specific, it means it's very difficult for the team to understand them. So if you can't understand something, you cannot work towards it. So objectives should be specific. They should be measurable. That the measurable is the M. They should be achievable. It doesn't make sense if you set objectives that cannot be attained. They're excessively maybe too big. You've been selling, let's say you've been making a profit of, let's say, 1 million dollars, and then you say in the current year objective is to attain 5 million. There is a very big gap between the 1 and the 5, so it means it could be not achievable. So the objectives should be achievable, they should be relevant, and they should be time limited. So that is what the synonym of SMART stands for. As you're setting different objectives, you can consider or try to put them in line with SMART. Ensure that they are specific, they can be measured, they are achievable, they can be attained by the team, they are relevant, and they are also time limited. So that is for the objectives, and this is something that we would also look at or would consider when we are trying to set key performance indicators for the organization. Because also KPIs are very important when we're trying to assess the success factors or the success of the organization. Sorry. So what will the KPIs help us with, or what are they going to help us do? They're going to help us measure how well the organization is performing against its critical success factors. Typically 1 or 2 KPIs will be chosen for each critical success factor that has been identified by the organization. So what are these critical success factors? What are critical success factors? Anyone has an idea what critical success factors are? Anyhow, so critical success factors, these are specific, or I could call them the limited number of areas where the performance should be satisfactory for the company to be able to achieve its desired goal. So these are very important. If the results from those particular areas are not adequate, it means the organization cannot be able to achieve its desired goal at the end of the day. So there are areas that are very critical, or the areas that the company must really perform best for it to be able to achieve the goal or even surpass the goal that has been set. So there are different pitfalls that involved in designing of KPIs. One of them is too few. Here we look at things that can be measured. What gets measured can get done. So it means areas where you cannot measure, you will typically get to ignore them, and then you cannot be able to achieve them. Look at you can say, for example, our key performance indicator is going to be, okay, maybe we can say profit. A profit is measurable, it's quantifiable. By means, other things like quality, which cannot be quantifiable, can easily be ignored. So I hope we are together on that. So the other pitfalls that involve, for example, we also have too many, where we have different indicators that we need to explain to management. So it means the more the different indicators for us to report on, the more the time that we shall need, or the more time we shall take to be able to explain all this, or be able to measure these different KPIs. What are the challenges, however, that would come along with that? It means there could be more important tasks, and at the end of the day, we may concentrate on the ones which are easier and not concentrate on the ones which are more vital, or more difficult to attain in an organization. So that's also a very big challenge. Instead of getting those which are extremely important and we focus on them, because of the indicators being quite many, now we would focus on different other things that could not be very vital. Then some of them could also be inappropriate. For example, if you apply a strict cost measure in an organization where maybe luxury products and services are sold, this is likely to distract from the organization's strategic success. How does that happen? If we are selling cars, maybe expensive luxury cars, we are trying to minimize costs that we want to incur. But remember, these are luxury products that we are trying to sell. So if you're selling a strategic item, it means now you have to make it appear so luxury for you to be able to attract the intended market. If you say this is a very expensive sports car, it can be able to do maybe this number of kilometers per hour. It can be able different things. Maybe the interior is this good. So if you try to limit the costs that you would now incur on maybe making the interior of the item, maybe that particular car, look extremely good or make it look extremely posh, it means that now that you'll be missing on what is important for the success of that particular item. So you may not be able to sell as much as you want because it's not appearing as much luxurious as it should, because you're focusing on minimizing the costs in the company. Then when you also look at the pitfall of it being too easy or too difficult. If it's too easy, or if it's too difficult, it may demotivate the team on focusing and working on that particular KPI. And if it is too easy, it would also affect the performance. The performance would not be extremely good, because now this is something very generic or something very easy to do by all the team members. Then lastly, we have a pitfall of hit and run, or we could also call it the tick box approach. Here, the KPIs need a management framework through which they are questioned or they can be challenged. Otherwise, they will not remain effective, or they will not keep relevant to an organization. So we have to continue trying to tick the box, or trying to find out if this KPI is still relevant at this particular stage in an organization. Any inquiries? Okay, if there are no challenges, let's look at the advantages of having non-financial performance indicators. And some of the advantages that we have is they are usually easy to calculate than the financial report, because they can be provided in a much shorter time, or what would say they can be calculated very quickly. Then they are more flexible, as organizations can come up with many measurable approaches to their objectives vis-a-vis to financial performance indicators, which have a specific way of having been attained. If we say current ratio is current assets divided by current liabilities, that is it. You can't change anything. But for non-financial performance indicators, they can be flexible. Then they can also be less manipulated, because we're not playing around with the figures as the financial performance indicators are, whereby if a profit has been manipulated, it means everything that would be computing using that profit figure would be manipulated. So those are the advantages that we benefit from non-financial performance indicators. And how can we be able to improve the performance? We can be able to improve the performance, one, by putting in place quality indicators. Just a second, let me connect to charger. So we said we can put in place quality indicators. Of course, different organizations put in place quality improvement programs that they can be used to measure or improve the quality of the products and services that are being offered to the customers. So you can put in place quality controls or quality assurances. So with quality controls, here we try to focus on measuring the quality of the products and comparing this with the predetermined standards that have been set by the organization. So we can maybe undergo a quality inspection of the products that have been produced to ensure that they meet the set standards. Then we also have quality assurance, where we have procedures that we put in place to ensure that we have good quality. For example, if we put in place quality processes before, it means if we have if we are using better quality materials, we can also be able to have improved better quality of the output. So there is an example, you can go through it here and also be able to do some computations for you to understand much better. So ensure to go through them, especially with this computation, so it can make better sense for you. So now let's proceed to customer service. Customer service is very important in all organizations, but most especially for the organizations whereby we use where we offer services. It's very, of course, now there, if your company is offering services and then the services you're giving are also not very good, it means now it will be difficult to have return customers or even new customers, because it means they will be discouraged to get back to the organization. So for you to have improved services, it means also it's best for you to put in place after sales service, especially now if you're doing manufacturing, to ensure that what you've given out to the customers has been able to serve the purpose that it should have served. If someone was if you're producing, let's say, a tile, and then you sell these tiles to clients, but when they fix them they break, it means that maybe the quality is not good and they're not getting satisfaction from what they have purchased. So doing after sales services could help you to be able to assess and get feedback from your clients to make you comfortable, or to ensure that you can be able to improve in places whereby you did not perform to the expected performance level. So for us to be able to assess this, we can use both the non-financial performance indicators plus the financial performance indicators. But of course, for the after-sales services or customer services, this cannot be checked or quantified, so it's difficult to use financial performance indicators. So most definitely we're going to use non-financial performance indicators. So there is a scorecard that you can use to provide top management with performance measures that can be used to assess the organization performance. For example, we can look at different 4 perspectives. The first one is the customer perspective. How do the customers see us as the company? We can also use the internal business process perspective. So here we look at what as the company must we excel at to be able to succeed. Then we also look at the learning and growth perspective, where here the company must continue to grow and change in the modern dynamic business environment for it to keep relevant. And then lastly, we have the financial perspective. Here we look at how do we look at the shareholders, or how do the shareholders look at us as the organization. So these 4 perspectives are very important, and they move hand in hand as they complement each other, because if one of the categories is not happy, it means that now it will be difficult. If customers are not happy, it means that sales will not be good, the profits will not be good, hence the financial perspective can also not be achieved. So, and also if you ignore maybe, for example, learning and growth perspective, it means you're not introducing any new products, you're not growing in the industry, so you'll be left behind, and as a result you can also not be able to achieve the best goals, or be able to keep the pace in the market. Then before you know it, you could be obsolete, or people would not be in need of your products. So all the 4 scorecards are very important and should be continuously checked and measured. So I would like to end here for today. I don't know if there are any questions for me. Okay, so if there are no questions, thank you so much for attending, and have a good night. Let's meet on Thursday.
Good night. Thank you.